Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. Although today we're going to need a little more than 5 minutes. For the past few weeks, we've been on an incredible world tour, exploring everything from the high-yield, high-headache markets in Mexico to the unique land-focused plays in Japan. But today, we're coming home. We're going to pull back the curtain on a strategy that's happening right in our backyard, but one that often feels just as foreign and out of reach: the world of private equity real estate. You've seen the headlines. A private equity firm buys a 300-unit apartment complex. You've probably thought, how do they do that? And how can I get a piece of that action? It feels like a club with a velvet rope and a very exclusive guest list. Well, today we're kicking off a new multi-part masterclass to get you past that rope. We're going to demystify the single most powerful tool for accessing these large-scale deals: the private real estate syndication. This is your gateway. To really understand where syndications fit, let's imagine the different ways you can invest in real estate as different ways of getting a gourmet meal. First, you have direct ownership. This is you buying a rental property down the street. In this scenario, you are the chef owner of your own restaurant. You source every ingredient, you write the menu, you cook every dish, and you wash the dishes. You have total control, and you keep all the profits. But it's a ton of work, and if a dish fails, the loss is entirely on you. Second, you have public REITs, or real estate investment trusts. This is like buying a gift card to a massive, publicly traded restaurant chain. It's easy, it's liquid. You can sell at any time, and you get a taste of the whole menu. But you have zero control. You don't get to talk to the chef. You can't change the menu, and the value of your gift card can go up or down based on the stock market, not just how good the food is. Plus, the tax benefits are minimal. This brings us to the private syndication. This is like becoming a silent partner in a single high-end restaurant run by a world-class chef. You don't have to cook or manage the staff. You trust the expert, the chef, to run the show. In return, you get a share of the profits from a top-tier establishment you could never open on your own, and you get the fantastic tax benefits that come with being an owner. This model has become the sweet spot for a specific type of person: the busy professional, the doctor, the lawyer, the tech executive, who has capital to invest and wants the powerful benefits of real estate, but simply doesn't have the time or the specialized expertise to be the chef owner themselves. It's for the investor who wants to own the restaurant, not run it. Now, let's switch to another analogy we'll use for this series: producing a blockbuster movie. Every syndication, every movie production has two key players. First, you have the general partner, or GP. In our analogy, this is the director and producer rolled into one. They are the seasoned real estate professional who does all the heavy lifting. They find the script, the underperforming property. They secure the financing from the studio. They hire the A-list cast and crew, the property managers and contractors, and they execute the business plan from start to finish. They are the expert in the trenches, and they carry the vast majority of the liability. Then you have the limited partners, or LPs. These are the investors. They are the executive producers. Their primary role is to provide the equity capital needed to get the movie made. In return for their investment, they get a significant share of the box office profits. Their liability is legally limited to the amount of money they invest. If the movie flops, they can lose their investment, but the studio can't come after their house. This is a world away from the personal liability you might take on as a landlord, where the risk structure is entirely different. This GPLP structure is the engine of private equity. It aligns the sponsor's expertise with the investor's capital to go after deals that neither could do alone. So you see the potential, you fit the profile. How do you actually get an invitation to these private screenings? How do you find these deals? Well, these are private investments regulated by the SEC, and they generally come in two flavors under a rule called Regulation D 506B and 506C. First, you have the 506B offering. Think of this as the private word-of-mouth screening. The director can't advertise this movie to the general public. They can only offer it to people they have a pre-existing substantive relationship with. This is the classic it's who you know model. A 506B can include an unlimited number of accredited investors and up to 35 sophisticated non-accredited investors. So How do you get into these deals? You network, you go to industry conferences, join local real estate meetups, and build genuine relationships with sponsors so that when they have a new script, you're on their call list. Then you have the 506c offering. Think of this as the public casting call, and the director is allowed to advertise this movie to everyone. On their website, on social media, on podcasts, it's much easier to find. But there's a catch. They can only accept money from investors who are verified as accredited. So what is an accredited investor? As of right now, it generally means you have a net worth of over $1 million, excluding your primary residence, or you've had an individual income of over $200,000 or $300,000 with a spouse for the last 2 years, with the expectation of the same for the current year. For a 506c deal, the sponsor has to take reasonable steps to verify this, so you'll need to provide documents or a letter from your CPA or attorney. Understanding this difference is key. 506b is about relationships. 506c is about reach. So let's bring it all home. What kind of movie are we making in this series? We're going to focus on one of the most popular and compelling strategies in the syndication world, value-add multifamily investing. This isn't about buying a pristine, finished product. This is about finding a film with a great story but poor execution, an older, underperforming apartment building. The director, our GP, comes in with a vision to remake it, renovating the units, improving the management, and raising the rents to market levels. They are actively forcing appreciation. You now have the map of this world. You understand the players, the rules of access, and the core concept. In our next episode, we're going to dive deep into the most important relationship in this entire landscape, the one between the director and the executive producers, the GP and the LP, and the critical legal contracts that define the terms of their blockbuster deal. Now, your challenge today, let's make this real. Your challenge this week is to take one concrete step to get on the inside track. Either find one real estate investor meetup in your area, virtual or in person, and put it on your calendar. Or find one syndication sponsor online who operates in a market or asset class that interests you. Go to their website and just review their past deals section. Your goal isn't to invest, it's to start seeing who the directors are in this industry and what kind of movies they make. Thanks for tuning in. I'm Martin Maxwell. Keep learning, stay strategic, and keep building, one smart move at a time.